A weird thing is happening in the 2026 stock market. People are not just searching stock market today. They are searching stock market crash 2026, stock market bubble, and today's stock market at the same time. That tells you the real mood. Prices are high, headlines are loud, and nobody wants to be the last person holding the bag. So this video is not a prediction. It is the bubble test, the four numbers that decide whether this market is expensive, fragile, or actually dangerous. The first test is valuation. When investors ask if stocks are in a bubble, what they really mean is this: are we paying too much for future earnings? FactSet's recent earnings work has kept the S&P 500's forward price to earnings multiple above its long-term average. That does not automatically mean crash. Expensive markets can keep getting expensive. But it does mean the market has less room for disappointment. If earnings miss or guidance gets weaker, the price can move before the economy looks bad. The second test is interest rates. This is the lever most people ignore. A stock is a claim on future cash flows, and future dollars are worth less when yields rise. That is why a 10-year Treasury yield around the mid-4% zone matters so much. At low rates, investors can justify paying more for growth. At higher rates, the same earning stream gets discounted harder. So the market does not need a recession to wobble. Sometimes all it needs is rates refusing to fall. The third test is the labor market. The latest Bureau of Labor Statistics report showed May payrolls up 172,000, with unemployment at 4.3%. That is not a collapse print. It says the economy is still absorbing higher rates better than bears expected. But there is a catch. Strong jobs can delay rate cuts, and delayed cuts can pressure the exact growth stocks that carried the market. So good economic news can still become bad stock market news if the market was priced for easier money. The fourth test is concentration. A healthy bull market usually broadens out. More sectors participate, small caps join, and the rally stops depending on a tiny group of winners. But the 2026 market is still obsessed with AI infrastructure, chips, cloud spending, and the biggest tech platforms. That can work while earnings are strong. The risk is that one crowded theme becomes the market's support beam. If AI winners stop beating expectations, the index can look stable one week and suddenly fragile the next. Now look at the safety trade. Gold and silver have not been acting like boring assets. They have become a live scoreboard for inflation fear, currency fear, and rate cut expectations. When metals rise while stocks also rise, it can mean investors want upside and insurance at the same time. That is not always bearish, but it is a clue. A market that needs insurance while making highs is a market where confidence is not as clean as the price chart looks. So here are the three paths. Path 1 is the melt-up. Inflation cools, earnings hold, AI spending stays real, and the market keeps grinding higher. Path 2 is the valuation reset. Rates stay sticky, multiples compress, and stocks chop sideways or fall without a recession. Path 3 is the crash path. Unemployment starts rising, earnings estimates get cut, credit spreads widen, and investors stop buying the dip. Only the third one is a real crash setup. The other two are painful, but they are not the same thing. The takeaway is simple. The 2026 stock market does not have to crash just because people are searching for it, but it also is not cheap enough to ignore risk. Watch four things: valuation, the 10-year yield, labor weakness, and whether the rally broadens beyond AI. If rates fall and earnings keep rising, the bubble talk can fade. If rates stay high and earnings roll over, the market's cushion gets thin fast. That is the real stock market crash 2026 test, not panic. Just the map.